Hello everyone and welcome back to Southern Wealth. I hope you guys are doing very well. If you do enjoy the content, please consider dropping that like and subscribe. So, yesterday morning I did a video. Around minute 14:45 of that video I said, well, according to my models, that should be the low point for crypto for quite a bit of time. Tuesday should be the low point of crypto, and US stocks were somewhere between Tuesday and Wednesday. And that model has an accuracy of 70% or more. And I said, yeah, I see it. Very likely that crypto has seen the weekly, the lows for the week on Tuesday, and most likely for quite a bit of time, that we're not going to see anything as low as that. So far, the model is holding, but it's still too soon to say. We'll see if that's the case or not. But quite some interesting developments as of late. I will refrain from talking too much about politics because I got my videos shadow banned if I do it. And I think this is one of the most important videos I would like for it to reach more people. And so today, let's look at a little bit TLT as its second day down. A little bit too red for my taste. However, we did have a massive upward movement, so it's normal that we have some sort of retracement, and actually we were bouncing out ahead in the 200-day, I don't remember if it was a 200 weekly or daily moving average, so it's normal that that level is going to be some strong resistance, so it would be good to see. The dollar index has been falling quite aggressively, which is very positive, and that ties into the loosening of financial conditions, which I will explain a little bit later. US stocks have bounced. There is some hope that tariffs will not be as bad as people thought. To me, there's still a big question this year, which is there's massive refinancing of government debt that comes from the 2020 years in which in which rates were very low. So it's going to be a big painful item in the budget if rates don't start to come down. So, and that has led to people to believe that Trump is looking to crash the economy on purpose to basically force the end of the Fed in cutting rates. To me, that's stupid. As I've said before, rates can move without the Fed. The Fed controls the short end of the rates. One thing that would be very helpful, for example, is for the Fed to stop QT, meaning the selling of bonds in its balance sheet, because it's another seller in the market. It doesn't need to resume necessarily money printing. Actually, if you look at TGA, the Treasury General Account, which had $800 billion, is now starting to be used quite a bit. So liquidity is returning to the market. So we had a good bounce in stocks. Basically, for you to have an idea, what we've done so far is we've in the US major indices, so I always look at the Nasdaq 100, Dow Jones, and the S&P, is we retested the 200-day and the 50 weekly moving averages, and so far we bounced from that. That's it. I know it's not as sexy as predicting a market crash and oh my god, the world economy is about to collapse and get finished and we're all going to zero. I know it's not as exciting. It's also not exciting for me to be correlating the stock market with, I don't know, Mercury position in the solar system, but it is what it is. We just retested a very important moving average that we from time to time do retest, even in the past years in which we went up 20%. In my view, financial conditions and liquidity is by far the most important things. And what we've seen when the election took place, and particularly Q4 of 2024, we had a very aggressive and quite in a short time frame, a tightening of financial conditions. So what does that mean? Because if you go to any of these channels or if you listen to people on TV, etc., they say, oh, tightening of financial conditions, easing of financial conditions. So first myth is the following. only the Fed controls financial conditions in the market by lowering rates or increasing rates. That's it. So that's the number one understanding. That's actually not accurate at all. You have two big forces, and this is why I look at them in particular. You have global M2 liquidity. So you have the global M2, in which it gives you very good proxy for liquidity in the overall markets all over the world, and that tends to increase over the years. Why? And it tends to peak in the same year that we are today, which is 2025, due to the refinancing timing of government debt. So that's one. Two is yields. Yields mean the rates in the bonds. So bonds go up, rates come down. Rates go up, bonds come down. Rates go up, tightening. Rates go down, loosening. Bonds go up, loosening. Bonds go down, tightening. That's it. So when we had the election in November, there was a rapid spike in yields in the bonds. Now you need to understand, the longer dated bonds, the 10, 20, 30 years, influence things like mortgages. Less mortgages get taken out, less houses get sold. That's a perfect example of tightening of financial conditions. You have less purchase of homes, house prices come down, house sales come down, everything comes down. Now, so that's one side, the long-term yields. Now, the Fed doesn't control those. The Fed controls overnight rates. Overnight rates mean the rates at which the banks fund themselves with the Fed. That's it. And the idea is the following. If the Fed funds rate is 4, then the 1-year rate is a bit higher, the 2-year rate is a bit higher, the 5-year rate is higher, the 10-year rate is, you get the point. The longer you go, the higher the rates. Now, if the Fed puts at them 0, then it kind of drags the entire curve down. That's the idea. When they lower the rates on the short end, it drags down the rates on the long end. However, it's not always the case. And what we've been seeing, that's why I look at TLT so much, it's basically filled with 20 and 30-year bonds. That impacts mortgages quite a lot. That also has an impact on the 10 and the 15-year, which are by far the most important levels to look at. If rates come down because people are buying bonds because they fear something, because they think inflation is coming down, whatever the case may be, then the bond market is already cutting for the Fed. So let's say if the Fed has rates at 4%, then let's say 2-year rate should be 4.5. But if the 2-year rate drops to 4.25, then the Fed already got 25 basis points or 0.25% cut for free. So the bonds going up and the rates coming down, it's loosening financial conditions. What's the other big item? The dollar. If the dollar is very strong, it tightens financial conditions. Why? Because half the world has debts in dollars. They need to pay interest on that debt in dollars. Where do dollars come from? The United States exclusively. So if the dollar is gaining stronger and more people are competing for the same dollars, pushing the dollar higher, that means they need to spend more money trying to get dollars rather than doing something else. So the dollar becomes very painful for every other country, friend or enemy, or neutral, it doesn't matter, which means if they are spending more money handling their dollar business, they are losing money they could be putting someplace else. Dollar goes up, tightens financial conditions. Dollar comes down, loosens financial conditions. What did we have in Q4 2023? Yield spiked, the dollar spiked, liquidity contracted. Give it 2 months, what did we see? Stocks came down, crypto came down, risk assets came down. And we've pretty much reached, or it's very likely that we have reached the bottom in terms of basically we priced, or we are seeing the reflection on the price of the tightest part of the financial conditions of Q4 2024. What happened in Q1 so far 2025? Yields came down, bonds went up quite a lot, loosening financial conditions. Dollar came down quite a lot, loosening financial conditions. Global liquidity has gone up. It's almost at November 2024 levels. Liquidity went up, loosening financial conditions. So when people are talking about bear markets and how the bear market is very likely to be here, and why the bear market is here already because of the tariffs or of this or of the other, you're not looking at what matters the most. Theoretically, conflicts should be very harmful for stocks. What happened? Oh, new all-time highs in the stock market and in crypto. Oh, but I thought that this was going to be very negative. Oh, inflation is really bad. What happened? Record all-time highs in stocks and crypto during high inflationary periods. Oh, it's the rates are too high. No way we can have assets going up. What did we have? New all-time highs, stocks and crypto. Why? Because the financial conditions and liquidity allowed for it. We had a liquidity plus extreme tightening of financial conditions in a very short time frame. There's a lag. We paid for it. Now, with this drop. And that tightening has reversed. That's it. It's not sexy. It's not exciting. It's not, oh my God, I thought that it was all because of Venus being aligned with Saturn. No. Oh yeah, now this is my favorite one. I saw Peter Schiff posting this. Oh, the Dixie is coming down, so inflation is going to go through the roof. The Dixie is at 104 right now. Throughout 2010 to 2021, the Dixie was on average 80. The average inflation of the US during that time period was 2.3%. When Dixie had the worst years, 77, 75, 78, inflation was 2.5%. When the Dixie was in high 80s, low 90s, inflation was less than 2%. What the hell are you talking about? This is the key. He's going to convince you, or he's going to try to convince you, that because the dollar index is coming down, all of a sudden CPI inflation is going to explode. Now, I'm going to grant you something. He made the same prediction back in 2010. Obviously, none of it happened. He kept predicting the same thing over and over and over again, which never happened. But he treats his followers as a Ponzi scheme. We need new followers as the old followers get out. That's it. So when you see people saying stuff like this, ask them, oh, really? Then why didn't we see this for 10 years when the dollar index was actually substantially lower than what it is today? They have no answer for it, so they won't answer you. Yeah, same thing with oil, right? Oil was going to go to $150 or whatever he said, and has done nothing but come down. So he doesn't talk about it. See, he ignores it. He goes someplace else. So, sorry, I know that this is not the most exciting of things, but it's important for you to understand in very basic terms what these things mean, right? And then you can tell, actually macro is getting substantially better than what we expected. Yes, it is. That's the point. Bitcoin is about 90. Ethereum is recovering. We need Ethereum to really pump for the altcoin season to come. The hackers have no Ethereum left. They've sold it all. And we're entering into a very positive phase in terms of liquidity and in the macro picture. Can a black swan happen? Yes, sure. I mean, of course, black swan can always, and anything can always go wrong in any cycle, in any year. It's just a reality. Either you can handle it or you can't handle it. There's nothing we can do. There's a summit for crypto on Friday. Everybody's looking at it. Let's see what's going to come up from it. There's a big rumor that capital gains tax will be removed from crypto. We'll see if that's the case. And very curious to see what's going to happen. When it comes to meme coins, I think I had this question. So meme coins are heavily conflated at the moment with the JPEG pump fun kind of garbage of Solana. Meme coins are much more than that. They actually have real communities and real cultish following, which is all positive. Those will see its place in the sun once again. Now we need to recover a little bit from the scare and the turmoil that we just recently have. That usually takes some time. People don't trust it for a while, and usually when they trust again, the prices are much, much higher. As I've told you before, people don't want to buy Bitcoin at 15K, they want to buy it at 100K. And they don't want to buy it at 80K, they want to buy it at 105K. It is what it is. So when people say in these Telegram groups and stuff like, oh, I hope that we have a dip so we can buy more. No, you don't hope for a dip. What you want is this. You want the price to fall by 50% so you can buy it. But then after you buy it, this is the key, you never want to see red again. Yeah, that's not how it works. I've said this in a video a while ago, but I will say it again. Strong believers create a bull market. Bull market creates weak believers. Weak believers create a bear market. Bear market creates strong believers create a bull market, blah, blah, blah. So, you know the drill. Things are going in the direction that we hoped for. Let's hope that my model is right. Once again, one can hope. Hope and cope. That's all we have here. But guess what? The people that made it in crypto were the record holders of hope and cope. And with that, thank you very much for your support, guys. Don't forget, drop that like and subscribe, and I'll catch you in the next one.